The Treasury needs $1.6 trillion by 2026. And here's what that means for real estate and how you can crush it. Listen up, people. The U.S. Treasury has got to borrow a whopping $1.6 trillion by the end of 2025. Not billion, trillion. And that's just the deficit punch. Not some chump change million or billion. It's a straight up trillion with a T. And this ain't just numbers on the screen. It's a debt tsunami that's going to jack up interest rates, choke out the economy, and slam real estate right in the gut. So here's the gut check. What the hell happens when Uncle Sam is the biggest, greediest borrower on the planet, sucking up all the cash? Stick with me, because the answer is going to separate the winners who stack millions from the losers who get buried alive in the next real estate bloodbath. Let's dive in and dominate. Here's what we're going to break down. Why does the Treasury suddenly need $1.6 trillion? For those of you that don't know me, my name is Shannon Robnett, and I've spent 30 years crushing it and getting crushed in business. And these lessons that I'm going to give you take me through booms, crashes, and all the BS in between. And right now, the sneaky government debt ripples are exploding in massive waves that'll drown the unprepared. So get ready and let's level up. Look, the government is blowing through cash like a bad habit. Total spending clocking in at $5.98 trillion just so far in 2025. That's per the U.S. Treasury. It's a massive pie. About 60% mandatory stuff like Social Security for $1.5 trillion, Medicare and Medicaid, that's another $1.5 trillion. And then you've got defense spending eating $900 billion. Well, let's not forget interest, because the interest on the debt alone hits $952 billion this year. And the rest, that goes to vets, education, transport, and the deficit is running hot at $1.3 trillion cumulative by June of 25 after the adjustments. Because revenues, all the tax money they collect, is only $4.35 trillion, and that leaves a huge gap. See, the post-pandemic stimulus, entitlements that have been exploding for boomers that are retiring, and the geopolitical crap like wars that are pumping defense, it's all adding up to this debt monster. And it's time to wake up, because this ain't sustainable, folks. Here's the worst part. Foreign investors are backing off hard. Holdings are shrinking over the last 2 decades. They're down about 30% of the total U.S. debt from the higher peaks. Why? Because currency hedging costs are killing profitability. And after the FX risks, they're barely breaking even or actually losing money on those treasuries. Geopolitical drama like China and US tensions, plus better yields elsewhere, like Europe and emerging markets. Fiscal worries over the endless deficit makes them think twice, because we have unsustainable debt, and that could tank the dollar or spark additional inflation. April's data shows that foreigners dumped $12 billion in T-bills alone. No more safe haven rush to the United States. They're underweight and staying that way. And this leaves the U.S. scrambling because higher yields needed to lure buyers. And that's screwing everyone else. Look, if you want to build wealth in this high rate, high debt economy, then you need this free guide I've put together called $425 million worth of lessons. It breaks down the exact playbook that I've used for 30 years to grow income, cut taxes, and invest smarter when the rules change. The link's below, so grab your copy today. Look, let's talk about what this does to interest rates. It's a classic crowding out. Governments flood the market with T-bills, like $1 trillion in Q3 of 2025 alone, sucking up the loanable funds and jacking up interest rates to attract buyers. Well, the supply overwhelms demand, so the yield spike. The 10-year Treasury, it's at 4.1%. That's the average projection for 2025. And you're borrowing? Well, that gets hammered because the banks and the lenders pass on the higher costs, and mortgages have jumped to 6.5% plus, making flips or refis just a nightmare. Less private investments means slower growth. But for you, if you adapt, you're going to do fine. If you don't, you're going to get crushed. Locking in fixed interest rates now before it worsens might be a good idea. Look, higher rates from this debt binge are choking real estate. Borrowing costs are skyrocketing, affordability is tanking, and home prices are up only 3% in 2025, and transactions are down over 30%. So cap rates expand. Refinancing distress hits the commercial market hard. Office vacancies are up. Multifamily is squeezed by labor shortages and costs. Cash flow gets eaten by debt service for investors. Flips die, but opportunities in forced sales and distressed deals might be on the horizon. Because the weak hands, they'll fold. And beasts like you, they buy low and they win big. The Fed's eyeing cuts. Markets betting on 0.5% 2 cuts by the end of 2025, maybe totaling 2.5 total through 2026, dropping the Fed's fund rate substantially. But massive Treasury issuance keeps the yields stubborn. For real estate, the cuts are going to ease mortgages down from 5.75% by the end of the year. Maybe. They're going to boost affordability. They're going to spark a buying frenzy. But don't wait, because delays mean missing distressed bargains now. Because if the Fed holds off, rates stay elevated. They crush the flips. They crush the refis. So you want to position now. You want to lock equity, hunt for cash flowing deals, and action quickly, because action beats waiting every single time. Here's the bottom line. The Treasury's $1.6 trillion problem is about to become your problem. Rates might stay higher and credit would remain tight if it does. But if you're prepared, the very same tidal wave that drowns others could carry you into a once-in-a-decade opportunity. Now here's the key question. Which strategy actually thrives in high-debt, high-rate storms? Click on the video on the screen to hear me talk about the multi-billion-dollar market no investor is talking about.